So the big question is the UK housing market vastly overvalued? Is it heading for a big fall? Or are the high prices a reflection of underlying forces? Let's find out. We can think of the housing market something like a seesaw. Pre-2022, there were more factors pushing up prices. Low interest rates, shortage of supply, inherited wealth, buy-to-let confidence, and recently the balance has decisively shifted, with more factors on the side of falling prices. Higher interest rates, falling confidence, expectations of falling prices, buy-to-let investors leaving. Let's explain what's going on. This is Rose Hill Estate, one of the largest council estates in Oxford. It used to provide cheap rental accommodation, but since the 1980s, most has been sold off to the private sector. It is one of the cheapest areas in Oxford, but a 3-bed semi can easily fetch £350,000, at least 10 times the average Oxford salary. According to this mortgage calculator, an average salary of £35,000 would be enough only for a £100,000 mortgage, which in Oxford would struggle to get you even a garage. 27 years ago, average UK house prices were £51,000, 3 times average salary. Today they are £265,000, and crucially, 7 times average salary. If you prefer the ONS calculation, the ratio is 9 times. In most of the post-war period, house prices were 3 to 4 times income, which is conveniently similar to the average mortgage lending multiple of banks. But in recent years, this price to income ratio has been broken, and the question is why, and can it be sustainable? Firstly, low interest rates have led to historically low mortgage rates, meaning investors have a logic to buy housing rather than say bonds. In the past 20 years, rising prices, low interest rates have encouraged a Ponzi style reinvestment. Investors rely on rising house prices to make profit, encouraging them to buy new properties. And rising prices fuel more speculative buying and a further push to prices. But the problem is, this can easily go into reverse if two things happen: higher interest rates and falling house prices. If interest rates on a £300,000 mortgage rise from 2 to 6%, landlords may struggle to break even with very high rents. The recent rise in mortgage rates is crucial for pushing us to a point last seen in 1991 and 2007. And for those who say interest rates are still low by historical standards, the difference is we have much more mortgage debt because of the very high prices. Secondly, if prices fall, who wants to buy to let and be left with negative equity? If investors stop buying or even sell existing properties, it adds to the negative cycle. And by the way, it will make it harder for private renters. We only have to look at many recent examples of significant house price falls, 1991, 2008, or further afield, Canada and New Zealand are all seeing 20% falls in house prices. But the story doesn't stop there. Firstly, as we are often told, myself included, the UK has an acute shortage of housing relative to the growing population. The government target of 300,000 new homes a year always fails to be met. So this shortage would help keep prices high. However, is it that simple? I went looking for some stats to prove this shortage point, but I was surprised at what I found. This is perhaps controversial, but is the UK housing shortage really so acute? Between 2011 and 2021, the number of households in England and Wales rose 6%, or 1.4 million. But the net number of dwellings in England alone rose by nearly 2 million. This means supply rose faster than demand. Now, there are, of course, real housing shortages in some areas, places like Oxford, London, and there is a very real shortage of private rented accommodation. But the overall shortage is often exaggerated. And if UK house prices are not being propped up by a shortage of supply. It means prices are more vulnerable to falling because of higher interest rates. So, if there is no acute shortage, how come people are able to keep paying ever higher income multiples? Well, in the past few years, past few decades, there has been a significant rise in wealth, especially for the top 20%. And rising house prices are a primary cause of this surging wealth gap. In recent years, the UK has become better at increasing wealth rather than income, and it tends to be the older generation who have benefited most from rising house prices, with young people squeezed out of the market. However, there is another element to consider. As Chris Giles pointed out in the FT recently, the older baby boomer generation are not frittering away this wealth on luxury holidays and cars, but are giving a larger proportion to their children. In 2021, the Bank of Mum and Dad contributed a total of £10 billion towards first-time buyers. In the past 10 years, a staggering £54 billion has been given or loaned to first-time buyers. To put it into context, it contributes to around 26% of funds to the UK housing market. So if you ever wondered how the average UK deposit for first-time buyers managed to be £60,000, the reason is help from parents to buy. So this is very important, as it creates an almost reverse Ponzi effect. Rising house prices means rising wealth, which enables parents to gift through inheritance more wealth to their children, who can then buy these very outrageous prices. Of course, it means a great disparity between those whose parents own a house and those who don't. If your parents can't help, the chances of getting on the property ladder are slim. But as far as house prices, it explains, at least in part, the rise in house price to incomes, where you are using wealth to push up house prices even further. Another aspect of the housing market is that in the post-war period, we had a long stretch of steadily rising real incomes, with growth averaging around 2.5%. However, since 2007, this has gone into reverse, with productivity and growth sharply slowing down. The UK still hasn't recovered its pre-COVID GDP peak, and the IMF predict the economy in the UK will do worse than Russia in 2023. Now, true, unemployment is low, but this won't save the housing market. For the majority of workers, there has been a prolonged cost of living squeeze. And nobody knows yet if the post-war growth period is over, or whether we will return to normal growth. But this is very important for the housing market, because stagnating real incomes will reduce buying power and reduce prices. The market cannot be sustained by inherited wealth alone. The only thing is that very weak economic growth will probably mean lower interest rates, as inflation falls quicker than expected. So is the UK housing market a Ponzi scheme? No, but it does have serious problems. Selling off social housing in the 80s and 90s without replacing it has contributed to a shortage of private renting, causing very high rent prices. Without generous lending from parents, housing is very unaffordable, and this reliance on inheritance or gift from your parents is only exacerbating inequality in the UK. But despite all this inherited wealth, prices are still very likely to fall considerably because of all the new downward pressure on prices. And if you're interested in the growing inequality in the UK, which is so important to the housing market, this video here goes into more detail.